CVS Health Corporation, ticker CVS, is currently trading at $75.42 and is down by 27% over the last year. If we have a look at the 5-year graph, we can see that CVS has experienced a fairly bumpy ride over the past 5 years, reaching its peak value of $109 in 2022 to then fall back down to $75.42. Now, one of the things I really like about CVS is their growth. If we have a look at the monthly full, we can see that the company has increased their dividend by almost 170% over the last decade. Similarly, they increased their free cash flow by 175% over the past 5 years to now stand at $13.5 billion annually. Now, all this free cash flow allowed CVS to acquire Aetna in 2018 for $78 billion, and in 2023 they are planning to acquire Oak Street Health for another $10 billion. And this only shows the growth CVS is going through, and of course, growth is the one thing an investor likes to see in their company. Nevertheless, to find where CVS is currently trading below its intrinsic value and whether now might be the best time to add it to your portfolio, we'll jump over to my fully automatic stock analysis spreadsheet, where we will have a look at the 9-pill analysis and find the intrinsic value using the Grams formula revised, discounting cash flow model, multiples valuation model, and the dividend discount model. And all these models will lead to our ultimate valuation at the end of the video. Now let's quickly jump back to the stock screener and have a quick look at CVS. We'll type in CVS as always, and the metrics will show up automatically. Now right away we can see that the current dividend yield for CVS is sitting at 3.24%, which is certainly above average for firms that operate in the healthcare sector. The dividend payout is sitting at $2.42 per share per year, and the payout ratio is sitting at 70%. Quite higher than what I generally like to see. I generally like to see a payout ratio below 50%, but 70% isn't that bad. Now, the analysts currently project a price of $114.34 compared to the current price, which is sitting at $74.76. The institutional ownership is 82.5%, and the beta of CVS is sitting at 0.61, which is great, showing that you won't see much volatility with this company. Up here we can see that the income of CVS has increased slightly over the past year. On the other hand, the cash flow has decreased, and net cash flow has decreased by quite a bit. As well, if we have a look down here, we can see that the current earnings per share is quite low compared to the historical earnings per share of CVS, as well as the PE ratio, which is quite higher than the historical PE ratio for CVS. But now let's jump to the 9-pill analysis. And right away we can see that CVS has a rating of 7 out of 9, which is a very good rating. Now the first thing that catches my eye is the increasing free cash flow over the past 5 years. And as we can see, the cash flow has been increasing by almost 20% year over year. Now in my opinion, free cash flow is probably one of the most important metrics an investor should look at when evaluating a stock, as it really gives you a perspective of how much money the company walks away with after subtracting all its expenses. Now we can also see that the 5-year PE ratio is certainly sitting below 22.5, and the price to free cash flow is very low as well. We can also see that there has been consecutive dividend growth over the past 5 years, sitting about 4.5% year over year. We also have the long-term liabilities over the 5-year free cash flow sitting below 3, and the 5-year profit margin sitting above 10. Now to the right here we can see that there has been no net income growth over the past 5 years, and instead the net income has been decreasing by about 9% a year. Now for me this isn't that big of an issue, as I can clearly see that there has been a large increase in free cash flow over the past 5 years, meaning that the firm is certainly getting their cash in different ways. But now let's move to finding the intrinsic value of the company. First we will apply the Grams formula revised. We'll plug in the ticker CVS, and as we can see, the intrinsic value for CVS Health Corporation is sitting at $54.60. Now take in mind that this specific valuation model is mainly based on the earnings per share of a company, and in general, companies that operate in the healthcare sector do not have high earnings per share. But let's move to the next valuation model, which is the discounting cash flow valuation model. We'll plug in CVS, and the free cash flow over the past 10 years will show up, calculating the average growth rate to be about 17%. Now I calculated the forward growth rate to be at about 5%, so we will plug that in, and as we can see, the future free cash flow for the next 10 years will show up. Now to move forward with this valuation, we need to calculate the present value of that future free cash flow, and we will do that by finding the discount rate. And as we can see, the discount rate of this company is sitting at about 9%. We take the present value of the future free cash flow, which we predict using the discount rate, add it up, add any cash and cash equivalents, subtract total debt, and get an equity value of 152,000, which we divide by the shares outstanding and get an intrinsic value of $118.46. Now take in mind that this valuation is purely based on the free cash flow of a company, and as I said before, CVS has a very good free cash flow. But now let's move to the next model, which is the multiples valuation model. Here I will be comparing CVS to Singa Group, Laboratory Corporation, Quest Diagnostics, and FMS. I took these companies' current stock prices and divided by their earnings per share to get their PE ratios. I then averaged out those PE ratios and multiplied the average PE by the earnings per share of CVS to get an intrinsic value of $50.83, which shows us that CVS certainly isn't undervalued compared to companies which operate in the similar sector. Now we can move to the final valuation model, which is the dividend discount model. Here I have plugged in the ticker of the company CVS, and the dividend payout over the last 5 years shows up, calculating the average growth rate to be at about 2.5%. I project a future growth rate of 2.3%, and that combined with the current WACC and the next year's dividend gives us an intrinsic value of $115.42, quite higher than the current price. Now that we have valued the company using the 4 different models, we can move to the final valuation, where we average out the Graham's formula, multiples valuation, discounted cash flow valuation, and the DDM valuation to get an intrinsic value of $84.83, which is about 13.5% higher than the current trading price. Now, as a value investor, I always like to plug in a margin of safety, and as we can see, margin of safety of 15% would not give us an acceptable buy price. Therefore, we will plug in a margin of safety of only 10%, which would give us an acceptable buy price at $76.34. Personally, I do believe that CVS will go up in price in the year 2023 and will keep rising over the next few years. And that is why yesterday I added this company to my portfolio at about $74.50 a share. Now, if you enjoyed this video, make sure to leave a like and consider subscribing if you want to see more evaluations such as this.